Hello everyone and welcome to International Business Law, the podcast series. I'm your professor Glenn Torres-Spelliscy. Thanks for joining me. In this lecture we explore the concept of money, investment, and the international regulatory system. We look at the process of investing in foreign markets and the information that needs to be provided, the approval process, and how to structure your business so as to minimize legal risk and exposure. We explore the trading of securities both domestically and internationally, as well as national and international banking systems. Indeed, for public companies, the sale of securities offers a relatively quick way to raise significant amounts of capital. But participation in securities markets is not without its risk, both from a market perspective as well as from a legal perspective. This is particularly true when securities are being bought and sold internationally. Because of the mobility of capital, complex international and national regulatory systems have developed. Foreign investment has a number of benefits. Indeed, all states want to encourage foreign investment in some ways, though in a lot of cases there is a palpable tension between domestic and foreign ownership interests. Domestic interests will want to protect their territory, even if allowing foreign money in may be beneficial to the economy at large. Well, first, it is distinct from simply buying a few shares in a foreign entity. Not every investment by an individual in a foreign country, company, or market will classify legally as foreign investment. It has to be of a certain magnitude. And generally speaking, in order to qualify as foreign investment, one person or commercial entity must own at least 10% or more of the controlling interest in a foreign enterprise. Majority or outright ownership is not required, but the ownership interest must be significant. Now, importantly, however, there are no international treaties that lay out the specific terms, and countries can choose to go lower or higher than the 10% threshold. So if you are thinking of investing, you need to examine a country's specific laws to ensure that you are complying with state policy. Foreign investments are usually regulated by bilateral treaties, known as BITs. BITs govern how investors may engage in the foreign market and lay out the process that the investor must go through in order to get an investment approved. Let's walk through an example. This is an investment application form for the Maldives. The process requires the investor to provide details of the company as well as the desired investment. It also includes a number of declarations about the company and its managers. If the investment is approved by the authorities, work can begin. Importantly though, the project is subject to constant oversight to make sure that it is meeting the goals laid out in the original application. When making a foreign investment, one of the most important questions that a business person will face is how to structure the corporation. There are a number of options that have a range of responsibilities and potential liabilities. When choosing a business form, you have to be aware of the various regulations you will be subject to, as well as the protections and risks associated with each type of entity. Companies can choose to establish partnerships, distributorships, representative offices, or local subsidiaries. All have different benefits and risks that we will discuss in detail in this chapter. Now, with respect to which regulations will control your business, you have to take into account two sets of laws. The laws of your home state, where the business is based, as well as the laws of the host state in which it will conduct business. This is a critical point to understand. In operating in a state other than its state of corporation, a business is bound to follow the laws of those other states, as well as the laws of its home state. For a multinational enterprise, operating in many different countries around the world, having to comply with multiple legal and regulatory regimes, is a cost that must be priced into any discussion of future expansion and development. Indeed, in a global marketplace, the profit potential of a multinational enterprise can be staggering, and many businesses will be looking for opportunities to expand internationally. However, operating as a foreign registered company in a foreign country has many legal pitfalls and challenges that all lawyers and international business people should be aware of and should take into consideration prior to entering into business in a foreign location. First and foremost, doing business in a foreign country may not be cheap. A company must be knowledgeable about its filing requirements. Most countries require that all companies, including foreign companies, file at least an annual statement with the government, and some will require more filings, perhaps as often as quarterly. Filings can vary widely in what information is required depending on the type of business, but the more that is required, the more costly it will be to prepare. As a result, an international business has to think about the resources its employees will have to devote to the filing, whether it needs outside support, such as a law firm, and perhaps a certified public accounting firm. And all this costs money and should be taken into account when assessing the business viability of establishing international operations. Second, when looking to establish foreign operations, a multinational enterprise must familiarize itself with local regulations governing its operations. It needs to understand the regulatory environment of the host state with respect to environmental rules, labor and employment, taxes, etc. For example, many states have local participation laws, which basically require multinational enterprises to partner with local companies to open up an office. Establishing the relationship often costs money and resources that have to be calculated into the final cost determinations for the expansion. And finally, an investor must think about risk. Various forms of business may expose the parent company to liability, which is something the company may want to avoid. One of those risks is that foreign currency, particularly in developing countries, can lose value quickly. So one thing that you have to think about when doing business abroad is to make sure that the currency being used in the contract is stable. Now, there are a number of ways to do this. The first is a maintenance of value clause, which allows for adjustment in the contract to match changes in valuation. A second method is using a money of account, meaning choosing a stable currency like the US dollar or the euro. Or finally, you could use a currency basket, where the prices in the contract are stated in a set of different stable currencies at varying levels. For example, perhaps 50% US dollar, 25% euro, 25% yen, etc. Although complicated to set up, it does provide for protection against problems with any single currency. The international system has also built in various regulatory mechanisms to protect currency value, like the IMF or International Monetary Fund, and those are discussed in the reading this week as well. Taxes are a reality of existence. In any large organized society, the ability to raise money through taxation is critical. Indeed, that was one of the founding principles of our own nation. The ability to levy taxes was considered a critical component of the U.S. Constitution. As founding father, fourth U.S. President, and drafter of the U.S. Constitution, James Madison concluded, quote, "The power of taxing people and their property is essential to the very existence of government," end quote. As a business person with a duty and interest in trying to lawfully generate profit for your shareholders, among the other interests we've previously discussed, you arguably have two duties. One, to pay all the taxes that you legally owe to all the governments you owe taxes to. And two, to use diligence in employing corporate strategies and techniques to minimize your tax burden to the extent possible. This week we will discuss what types of strategies are permitted, including corporate inversions, and which are not, as well as the issues that a professional must watch for, such as tax treaties and the basis of taxation. Well, that does it for this week's short podcast. Let me know if you have any questions, and I will see you on the discussion boards.